Thanks for joining us on Parlance. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Meera Dugal. Let's get you the headlines. Markets trade lower with selling pressure seen across all sectors except pharma. Broader markets fall in line with benchmark indices.
Sun Pharma will merge its domestic distributor Aditya Medisales with a wholly owned subsidiary, also appoints new auditors for its subsidiaries.
Prabhat Dairy sells its dairy business to French giant Lactalis for 1,700 crore. The bigger story is that they've sold most of their business, 98% away.
Bankers oppose external benchmarking of floating rate retail loans. Indian Banks Association seeks an audience with the Deputy Governor, N.S. Viswanathan.
All right, let's first take a look at how markets are faring. Down more than 0.5%. Yatin's here with us.
So after Neera, 0.5% down on the indices and almost 76 point down on the Nifty at this point in time. Of course, the market breadth also is not looking that great. So we have only 13 advances to 37 declines as far as the NSE Nifty 50 is concerned. And clearly the gap between the advance and the decline is increasing. So clearly we have seen some pressures coming in after early day in trade. What's pulling the index down is select metal names. So we have the likes of Vedanta, Tata Steel, JSW Steel. All of these stocks are down anywhere between 3 to 3.5%. So the pressure really continues on the metal stocks. Also we have Mahindra and Mahindra as well as HCL Technologies, which have seen some sharp corrections coming in for the trade on good volumes. What's doing well in the marketplace is Sun Pharma, and of course after the decision for the business restructuring and clarification coming in on auditors as well as business entities has led to some cheer on the street after the correction that we saw on Sun Pharma. So 5.5% for that name. Kotak Mahindra Bank is doing well after the quarterly earnings that they declared yesterday. So 2% up for Kotak Bank as well, and Dr. Reddy's, BPCL also are the other stocks which are active in trade. And as Zira was mentioning earlier, Prabhat Dairy, that stock is in focus, almost 10% up for that one after the board approved a slump sale to the MNC for the majority of the business. So that stock of course has come down from the day's high. Clearly investors not cheered. A company's market cap is close to 1,800 crores and the deal quantum is nearly 1,700 crores with the dairy company.
Yathan, thank you for that. Let's move on to the other story. Bankers are not too happy with the RBI's directive asking them to link all floating rate retail loans to an external benchmark. 5 bankers in the know have told Bloomberg Quint that the IB has sought a meeting with the Deputy Governor of the Reserve Bank of India to extend the deadline. Vishwanath is here to tell us why bankers are concerned.
Well, firstly, the deadline was supposed to be April 1st, 2019. That's when the bankers are supposed to start with this linking to the external benchmark. The bankers feel that, firstly, the system is not geared up to go for an external benchmark. They say that the deposits are not linked to an external benchmark, so why loans? And thereby there will be a mismatch of sorts, and which will affect their business and their profitability. Bankers are also, to prove their point, they had done this sort of a back study. They went back 2 years, looked at their loan rates, home loan rates under the MCLR regime, which is the current regime for interest rates. And they also created a hypothetical situation where they took the 182-day treasury bill, used that as an external benchmark and plotted the interest rates that could have been. And looking at both the rates, there has been considerable volatility whenever treasury bills were concerned. And in some cases, the difference between the two interest rates were about 100 basis points. That is, the treasury bill linked rate was 100 basis points higher than what the MCLR would have worked out to be. So bankers feel that because of this extreme volatility in the benchmark linked rate, they should not go for something like this. Bankers are also saying that currently the MCLR regime is already subject to audits by RBI. So it is unfair to say that bankers are artificially inflating the MCLR rate and not allowing transmission to go through to the end customer. If it is already a very transparent rate, and if it is working, why tinker with it at all? Why go for an external benchmark? So these are all concerns that bankers have raised. They are seeking a meeting with the Deputy Governor. They previously met with Shaktikanta Das, the RBI Governor, who then directed them to meet with N.S. Viswanathan. So as and when that meeting happens, these points will be put forward.
Vishwanath, obviously bankers are painting this as an all bad, scenario, but it isn't all bad. Firstly, it must be pointed out that we have struggled with both loan pricing and monetary transmission. Plus, if you break this up into what it means for consumers, banks, and the economy, there are pros and cons.
Absolutely. So as far as consumers are concerned, the benefit of this would be that the interest rates would be extremely transparent. Their ability to judge whether they go for Bank A or Bank B would be better because the interest rates are then clearly in front of them. The cons would be that if it is linked to an external benchmark which is highly volatile, then that sort of brings in volatility into their interest cost that they would have mapped out for, say, a home loan. Home loans currently are the safest bet as far as banks are concerned. The fear that bankers have is that if you bring in volatility, there's a chance that customers may default more on their home loan repayments, and that's a concern that bankers are raising. As far as the banks are concerned, the benefit of going for an external benchmark is that there will be better liability management. You would have a system where bankers would be currently, public sector banks, which control most of the banking system, don't really have very sophisticated treasury systems to be able to manage their liabilities better. That is why they depend largely on calculating their interest rates on the basis of just deposits. This can be countered if you have an external benchmark rate. The con of that is that the problem they're raising, profitability, their margins are going to get squeezed because the ability to judge or the ability to decide on an interest rate depending on whatever they feel is the business reality may go away because it's pretty scientific than a straightforward formula. As far as the economy is concerned, however, things are pretty, it looks great because overall, if you look at the way things have been structured for the economy, this will work out to be a transparent system, which is obviously a good thing. It will lead to better transmission. The RBI has been struggling under the base rate regime, under the MCLR regime to ensure transmission reaches the end customer. That will improve, hopefully. This will also lead to better credit behavior because eventually customers are, the fear of defaults aside, customers will cope up because it's a home loan at the end of the day or some kind of retail loan. So they will end up repaying it on time, and that way, in general, credit behavior will improve. It will also improve on the corporate lending side, which is something that the bankers have said they're okay with if you go for an external benchmark. This will also lead to better risk management as far as liquidity in the system is concerned. That will be managed better. So overall, for the economy, this looks like a largely positive move. But if bankers are clearly opposing it, then we'll still have to see what the RBI has to say. In the past, RBI hasn't listened to them mostly, but we'll see what they do.
All right, Vishnu, thanks so much for that. But stay with us. There is another story that we want to pick up on. The bankruptcy board is pushing lenders and resolution professionals to speed up the insolvency process. They had a meeting yesterday, and it's the top 12 NPA accounts which are the cause of concern. Vishnath, what exactly happened at this meeting? So
this meeting that was called for was because there have been considerable delays as far as resolution of these 12 accounts at least go. Remember, they got into admission stage in June 2017. So about a year and a half now, and we've actually seen actual resolution and recovery in only 3 assets. Bhushan Steel, there was a Moneth Ispat, and then there was Electro Steel Steels. These 3 have been sold. Money has come into bank accounts. For a lot of them, there have been liquidation orders, but those are still dangling, within the liquidation phase. For most of the accounts, still there is no resolution in sight. Resolution has reached the last stage, like in SR Steel, but still things are not moving forward. So obviously the government is concerned, the IBBI is concerned. It undermines the law in some ways. In their conversation with the resolution professionals and bankers, they sought more information as to what was causing this delay. And the bankers and the resolution professionals were clear that it's clearly a delay on the NCLT's part, that they're not really giving orders which can take these cases forward. To this, the government said that probably you need to make better legal arguments. I'm not sure how that helps, but it could mean that they could go to higher courts. They could go and ensure that NCLATs or the Supreme Courts of the world will push the NCLT to make a decision. So that will obviously help them in coming up with a better resolution plan. But overall, they're saying that move faster, ensure that cases are resolved quickly, so that you have a better resolution rate, you have a higher recovery rate. As time passes, obviously, you lose out on the ability to recover money. So yeah, that's precisely what the discussion was about.
It's this delay that's worrying a lot of people. Thanks, Vishwanath, for that. Sun Pharma, meanwhile, has taken some remedial measures to address the corporate governance concerns raised by investors. The drug makers also issued clarifications on a slew of allegations that have been reported by various media organizations. Darshan is standing by to sum up the announcement that Sun Pharma made today. Darshan.
Yeah, so Harsha, if you know that in December when Dilip Sanghvi had the press conference, he addressed a lot of issues, but there were 3 or 4 issues which required a lot of remediation, and that didn't get covered. So basically, the clarification comes today is in terms of this issue. The first one was Aditya Medisales, and why this was not disclosed that it was a related party, and Dilip Sanghvi that time had said that given the investor interest, and if that happens, they are ready to buy out or merge Aditya Medisales from a related party to its subsidiary, and that will be done at a cost. So that is something that they have done. That's the first thing that they're looking to do it, and by the end of the first quarter FY20, this will be done. The second one, when that was the big one, a 2,200 crore loan given to a company called Atlas Global Trading. That was there. People that time, they didn't disclose who this company was. They just said it's an unrelated party in the pharmaceutical business. What they have done is that, and there was a lot of furor over why this unrelated loan was given. Now they have said that that was on account of liabilities that Atlas took over because Sun had to pay, and the reason that that Sun would supply them with drugs. Since Halol issue happened, they were not able to supply, and in lieu of that, a loan was given. Now they have said that, you know, over the next few quarters, that entire loan will be reversed. The money will come back to Sun Pharma, but there's no clarity on how Sun will repay Atlas Global if that money is coming back. The third one was changing in auditors. There were at least 16-17 subsidiaries of Sun Pharma which were audited by Walia and Timbadia, which were actually accused of some wrongdoing in the market. So they are saying that they are replacing this auditor with some other auditor. And finally, the entire issue of loans given to Suraksha Realty, which is a firm that is owned by Sudhir Walia, the brother-in-law of Dilip Sanghvi. Even in that call that time, Dilip Sanghvi maintained that there were no loans or guarantees given. Even in the release today, they say there is absolutely no loan or guarantee given. Probably can be true because the loans were given by Aditya Medisales as per the whistleblower, but Aditya Medisales was not a part of Sun Pharma. It's a promoter entity. So that is something that he's clarified.
All right, Darshan, thanks so much for that. You can read all the details on that on BloombergQuint.com as well. Meanwhile, Prabhat Dairy will sell its milk processing business, which generates nearly all of its sales to French firm Groupe Lactalis for 1,700 crore. Prabhat plans to pivot into an animal feed and genetics company after its exit from the dairy business. But what do shareholders get in return? Agam Vakil joining us. Agam, quite the controversy about the way they're doing this.
Oh, yes. Well, given the fact that they're actually moving out from a subsidiary, is, that leaves the question open whether or not there could be an open offer. But we've ran some calculations right now, some back of the envelope ones, and from what we understand right now is first we need to understand how this transaction is going to play out. They're first going to sell their Sunfresh Agro subsidiary to Lactalis, and for about 1,200 crores. That's 1,227 crores to be precise, and that will be followed by selling the rest of their milk product assets to Sunfresh after it has been sold to Lactalis. The endeavor here was to understand what shareholders get. So before that, we also have to understand how the cross-holding pans out for Prabhat Dairy and its subsidiaries, Sunfresh Agro, as well as Cheeseland Agro. So Prabhat Dairy owns 100% stake in Cheeseland, and Cheeseland in turn holds 71% stake in Sunfresh, and the remaining 29% stake is held by Prabhat Dairy directly. When it comes to your calculation for Prabhat Dairy and the shareholders here, if you consider just the 20% gains tax based on the book value that we have removed from its annual report, that comes down to around 17.5 rupees per share for the Sunfresh Agro stake. And of course, I haven't really added surcharge and cess. If you add that, it'll go up to around roughly 20-odd%. I just wanted to keep things simple there. And for the Cheeseland Agro space, well, the calculation comes to roughly around 943 odd crores, but because there is an indirect aspect to it, I haven't gone ahead and calculated the kind of the realization that the shareholders may make. At the end of the day, what we can drive in terms of conclusion is that shareholders will at least make 17.5 rupees per share in terms of cash. But the bigger chunk that is to do with Cheeseland and the subsidiary, well, we have a lot of question marks here, and we are awaiting more clarity from the company too.
Agam, thank you so much for that. Let's move on. ICRA has put 6 mutual fund schemes under ratings watch with negative implications. The rating agency cites their exposure to special purpose vehicles of ILFS. Yash is here with more clarity on what these funds are and what the risk is. Yash.
Afternoon, Harsha. So ratings firm ICRA has come out with a big rating downgrade on 2 of the SPVs from IL&FS. And now this correspondingly has also prompted them to put the ratings of 6 mutual fund schemes under watch with the negative implications. Now, which are these schemes? 2 of them are from the HDFC Mutual Fund stable, which is the HDFC Short-Term Debt Fund and HDFC Banking and PSU Debt Fund. They have an exposure of 0.55 and 0.3% of its total AUM to these SPVs. There are also 3 mutual fund schemes from the UTI stable, so UTI Banking and PSU Debt Fund. That has an exposure of close to 7% of its total AUM in these SPVs, along with the UTI Bond Fund and the UTI Dynamic Bond Fund. That apart, also Aditya Birla Sun Life Short-Term Opportunities Fund makes up the list of the 6 schemes which have sizable exposure to these SPVs. Now, what we understand is that because of this, there would be huge mark-to-market losses for these funds, which would correspond into a big downtake when it comes to the NAV changes based on today's closing. So one should watch out for these funds in today's day of trade.
All right, Yash, thanks so much for that. The liquidity squeeze may be over, but the pain will linger on for some time more. That's a word coming in from Sanjeev Bajaj, Managing Director of Bajaj Finance. He says NBFCs need to price risk better if they're to avoid a similar situation in future. Speaking to Menka Doshi in Davos, he also talks about some of the other things that NBFCs need to address to ensure they build sustainable businesses.
The liquidity squeeze that affected some NBFCs and HFCs is behind us now.
Okay.
Bajaj Finance has been okay because we follow very prudent practices. But the bigger question is to understand why this happened. If it was because of company A or B, that could very easily have been addressed instead of making this a much larger industry issue, which it wasn't. And that's something that the regulator needs to think about, how to prevent something like this from recurring.
Okay, so that's specifically what I wanted to talk to you about. I think the asset liability mismatch, the limited sources of funding, especially wholesale funding, that the NBFC industry has witnessed, over its sort of 3, 4, 5 years of explosive growth. What in that model specifically needs to change if that growth were to return, maybe at a moderated pace, and to sustain?
I would say 4 things. 1, risk needs to be priced better. We're going through a period where the public sector banks are not able to lend. They're going through their own challenges. Hence, a lot of liquidity went into NBFCs, especially even younger, newer NBFCs. Flushed with this money, they started lending at rates which didn't really match the risks that they were taking. And it's not just the risk to the customer that you're lending, it's a risk of learning that comes from spending years going through the lending cycle.
Sure.
So to me, that's one. The second is in terms of asset liability matching. Very clearly, for any NBFC or for any bank, the closer you match your assets to your liabilities, the less is the chance of getting caught in a liquidity squeeze. And a few HFCs were not, and I think they got caught out over there. Third important thing is, in general, liquidity availability to banks. We need to see to the larger NBFCs. If you look at the top 10 NBFCs today, each one of them is 10,000 crores assets and above. Bajaj Finance is over 100,000 crores in assets. We're bigger than most banks. It is important to sit down and rather than to think of whether this is an NBFC or a bank license, to try to think about how do you structurally make these 10, 12, 15 NBFCs, not the remaining 7,000, but these 20 of them stronger, because they're playing a significant role in the economy, but naturally they're systemically big now. So that needs to be taken care of. And to me, the last major issue over here is why wasn't there a run on the banks 4 months ago? Because there is a certain understanding that the banks will always get protected by the RBI. I think a similar understanding is to be there for these big NBFCs. Now, what it means, what the details are, those things need to be worked out.
Yeah, I think a couple of things that you touched upon is that pricing risk needs to be, sort of a better, more sophisticated done job. What do you mean by that? What is it that as an industry, and let's assume that we're partitioning the industry. We're not talking about all 7,000. We're talking about, let's say, the top 50 or the top 100. What has the industry got wrong in terms of pricing risk accurately? Has it been runaway growth where their asset quality is now coming into question? Because as yet the numbers don't seem to suggest that.
Okay, so let me try and give you one example. Let's look at home loans. Home loans to a salaried employee working in one of the top 500 companies in the country, and home loans to a self-employed individual.
Right.
The salaried employee in a large established company is always seen as lower risk and hence should get lower pricing. 3 years ago, the gap between a salary and a self-employed customer in terms of pricing was probably 125 bips. That's today almost the same. So because there's so much money coming in, as a result competition coming in, they're all going and lending to the same people, and hence the risk premium that you should have built into your P&L, knowing that the default of a self-employed customer in a particular situation, economic slowdown, is greater than a salaried guy in a big 500 company that's going to go on.
Sanjeev Bajaj there. Let's move on. Vodafone India and Idea Cellular came together to create India's largest telecom operator. The plan was to build on the synergies and put up a fight with other heavyweights like Airtel and Reliance Jio. But it hasn't quite gone to that plan. The stock dropped more than 10% over the last 2 trading sessions before stabilizing today. So what's ailing the telecom operators? Sumit is here with some answers. Sumit.
Well, there are a couple of reasons that has been ailing Vodafone Idea in the last couple of days. Now, firstly, it is if you see the management commentary that has come in from Reliance Industries analyst meet. Now, in the analyst meet, the management said that they are currently happy with the tariff structure and they have no plans to increase their tariffs going forward. Now, why is this important for Vodafone Idea? Now, currently, if you see in the telecom market, Jio is the price setter, and if Jio is not willing to increase tariff, it means that the pricing pressure will continue to remain in the telecom industry. Now, because of this pricing pressure, in the past, Vodafone Idea was hit the most. If you see the company's active subscriber base, it has been coming down continuously. In the last 7 months, they have lost more than 2 crore active subscribers. Along with that, the company's revenue market share that has also been declining. It has come down to around 32% from 42% in the first quarter of financial year 2018. So this company has been hit the most because of this pricing pressure, and if it continues in the telecom market, then Vodafone Idea will be impacted the most, and that's the reason why the stock has been ailing firstly. Now, second is the fund infusion that the company has planned tomorrow. Now, tomorrow the management will be meeting to discuss the details about the fundraising plans. Now, earlier the company had said that they are planning to raise close to 25,000 crore rupees. Now, a 25,000 crore rupees fund infusion by Vodafone Idea would lead to a 45% equity dilution. That's a big number for Vodafone Idea, and that is the second reason that has been the overhang on the stock prices of Vodafone Idea. Lastly, if you see this planned fund infusion that the company has been doing, that they are doing this fund infusion to pay their debt, but after this fund infusion also their leverage ratio would continue to remain high. Now, if you see the company's gross debt, now currently it is close to 1,26,000 crore rupees. So the FY19 leverage, that is gross debt to EBITDA, would be close to 28.6 times. Now, post this fund infusion, this leverage ratio would come down to 23 times, which is still very high. Now, separately, the company has also planned to sell the stake in Indus Towers, now which would fetch them close to 6,000 crore rupees. But the leverage ratio post this stake sale also would remain more than 20 times. Now, the company is expecting some synergies to come in worth around 8,400 crore rupees because of this merger. But these synergies will come in financial year 2021. So there are still 2 more years for the synergies to realize. Now, with such a high debt and such a high leverage ratio, there are chances that the company might need another fund infusion in the next 2 years to maintain to lower their leverage ratio because the synergies will still take time. So this will continuously remain an overhang on the stock because this fund infusions would lead to equity dilutions for Vodafone Idea in the next 2 years also.
All right, Saman, thanks so much for that. The Shapoorji Pallonji Group is looking to sell some of its assets in a bid to pay back debt. This comes after credit rating agencies cut the ratings of at least 5 of the group's companies. PR Sanjay of Bloomberg News joins us with more details. Sanjay.
Hi. So there are 3-4 elements to the story where Shapoorji Pallonji is claiming that no operating company other than Shapoorji Pallonji and Co has been downgraded, and they're claiming that it's all 5 units of the main company, so parent company. So that's one element. They're also saying that they are in they are hoping for restoration of the these ratings soon because they are in the process of selling a slew of assets, including real estate and water purifier business, and they're getting also some investment into solar business. So they are expecting these three measures will help them in restoring the ratings which they lost in the past, and they are claiming that this is a matter of the past, and they have already moved on, and they are in course, in line with their expectations to get some more money from investors. And the IPO, the proposed IPO for European Forbes will also fetch them some money. They're expecting so.
Sanjay, thank you so much for that. Let's move on. IMF has reduced its global economic growth forecast, citing emerging risks like trade tensions and a no-deal Brexit. Menika caught up with the chief economist of IMF, the newly appointed one of that, Geeta Gopinath, in Davos, to get IMF's prescription to counter the slowdown and what they make of the Indian economy ahead of the elections.
We've reduced the forecast for 2019, but it's important to note that the revisions are modest. And it's being driven in advanced economies. It is being driven by a slowing of growth in the euro area. Within the euro area, it would be Germany and Italy. So that's what it looks like for the advanced economies. What we are more concerned about are the growing risks to the global economy. And there are several of those. Some of the important ones are an escalation in trade tensions, a worsening in financial conditions, no-deal Brexit, and in the event of a faster than expected slowdown in China, the consequences of that for the global economy would be far more negative than what we have right now.
Okay, my next question is a two-part question. Do you believe there is enough room, both from a monetary policy point of view as well as from a fiscal stimulus point of view, to counter some of the slowdown that you're referring to? That's one. And the second is, you've also focused on the impact on financial markets. So you've said a range of catalyzing events in key systemic economies could spark a broader deterioration in investor sentiment. What is it that you're expecting?
Policy space is indeed limited. It is varied across different countries. There are some countries for which there is abundant policy space, but there are others for which policy space is quite tight. Monetary policy has barely normalized in many of the countries of the world, and so that is a concern. What we are recommending is that, given that growth, while has slowed, is not declined precipitously, we still think that there is some more time left for certain countries to build up buffers, fiscal buffers, and so that in the eventuality that there would be a downturn next time around, that they would be better prepared.
Okay, and the financial market impact?
The financial market impact is a big one. For much of 2018, while the trade tensions were ongoing, it appeared that advanced country financial markets were disconnected from the trade tensions. But recently what's happened post-October is that those two have come together. They become more intertwined. And the risks of that are high. And why is that? It's because we are living at a time when debt, both in the private sector and in the public sector for many countries, is quite high.
Yeah. So you've spoken of sovereign yields, you've spoken of corporate bonds in the US. What are you watching very, very closely in 2019?
We watch many different indicators. We certainly watch what's happening closely in the financial markets in terms of sovereign spreads, in terms of corporate borrowing costs, in terms of market sentiment. There's also been a change in financial market sentiment in terms of a more pessimism about corporate earnings. A lot of this is going to depend on what happens with the trade uncertainty, with Brexit uncertainty. So these have to be resolved.
Okay. One final question on India. We're in an election year. The fiscal situation is looking a little tough. Do you think India has room for a substantial farm benefit situation? I don't know what to call it. I'm not sure it's a loan waiver. We're not sure it's going to take some form of a direct benefit scheme or a UBI that people have discussed. What are you looking forward to?
We don't speak directly to kind of individual policies that countries should follow. But in the case of India, what we flag is the fact that the overall consolidated fiscal deficit remains high, and it's been the case for the last 5 years. So we certainly need to fix that. We need to address that. GST revenues have not come in at the rate at which it was expected, and so that would be an area for continued improvement.
Geeta Gopinath of IMF. Out of time on the show. Thank you so much for joining us today.
Lots more coming up on Bloomberg Quint. Stay tuned.